Argentina has defaulted on its sovereign debt 9 times in its history. Greece needed 3 separate bailouts totaling €289 billion just to avoid complete economic collapse. Lebanon's currency lost 95% of its value in 2 years. And right now in 2025, dozens of nations are teetering on the edge of financial catastrophe. But here's what nobody tells you about national bankruptcy. It's not an accident. It's not bad luck. It's a mathematical sequence that follows the same predictable pattern every single time. And once you understand this pattern, you'll see why some of the world's most prosperous nations are walking straight into the same trap that has destroyed empires for centuries. Most people think countries go bankrupt like people do. They spend too much, save too little, and eventually run out of money. But that's not how sovereign debt works. When a country defaults, it's not because they literally have no money. It's because they've reached a point where the mathematics of their debt structure make repayment impossible, regardless of how much wealth the country actually possesses. And this mathematical impossibility follows a sequence so predictable that you can identify exactly which stage any country is in right now. There are 5 stages to national bankruptcy. Stage 1 is prosperity through borrowing. Stage 2 is debt service consuming growth. Stage 3 is refinancing becomes essential. Stage 4 is confidence collapses. And Stage 5 is default or restructuring. Every sovereign debt crisis in modern history has followed this exact progression. Spain in the 1500s, France in the 1700s, Germany in the 1920s, Argentina multiple times, Greece in 2010. The pattern doesn't change because the mathematics don't change. But before we dive into the 5 stages, you need to understand what makes sovereign debt different from personal debt. When you borrow money, you have to pay it back with money you earn from work or investments. When a country borrows money, it can pay it back in 3 ways. First, through tax revenue from economic growth. Second, by printing more currency. Third, by borrowing even more money to pay the interest on existing debt. This third option is what creates the trap. Because once a country starts borrowing just to pay interest on previous borrowing, they've entered what economists call a debt spiral. And debt spirals only end one way. Let me show you how this works with a simple example. Imagine a country with a $100 billion economy that borrows $50 billion at 5% interest. They owe $2.5 billion per year in interest payments. If their economy grows by 3% annually, that's $3 billion in new economic output. The interest payments are manageable because growth exceeds debt service costs. But what happens when they need to borrow more? Maybe for infrastructure, maybe for military spending, maybe just to refinance existing debt when it comes due. Now they owe $75 billion at 5% interest. That's $3.75 billion per year in interest payments. Their economy is still growing at 3%, but that's only $3 billion in new output. Interest payments now exceed economic growth. They have 3 choices: raise taxes, which slows economic growth, cut spending, which also slows growth, or borrow more money to make the interest payments. Guess which option politicians always choose? They borrow another $25 billion. Now they owe $100 billion at 5% interest. That's $5 billion per year in interest payments on an economy that only grows by $3 billion per year. The debt is now growing faster than the economy can support. This is stage 2 of the pattern, and once you reach stage 2, stages 3, 4, and 5 follow with mathematical certainty. Stage 1 is prosperity through borrowing, the golden years. This is when debt feels like free money. The country borrows to build infrastructure, fund social programs, modernize the military, or stimulate economic growth. The borrowing actually works initially. New roads increase trade. New schools create skilled workers. New hospitals improve productivity. The debt generates economic returns that exceed the cost of borrowing. Politicians point to rising living standards as proof that their spending policies are working. Argentina experienced this in the 1990s. After decades of hyperinflation and economic chaos, they pegged their currency to the US dollar and borrowed heavily to modernize the economy. Foreign investment poured in. Buenos Aires became the Paris of South America. Shopping malls filled with imported goods. The middle class expanded rapidly. GDP grew by over 8% in some years. The debt seemed manageable because the economy was growing even faster. Greece experienced this after joining the European Union in 1981 and especially after adopting the euro in 2001. Suddenly, Greece could borrow at German interest rates because creditors assumed the European Union would never let a member country default. Greece borrowed to fund infrastructure projects, social programs, and public sector employment. The 2004 Olympics in Athens showcased a modern, prosperous Greece. Living standards rose dramatically. Unemployment fell to historic lows. But stage one always contains the seeds of its own destruction. The prosperity is real, but it's borrowed prosperity. The infrastructure gets built, but with debt. The living standards rise, but they're financed by future tax revenue. The economic growth is genuine, but it's dependent on continued borrowing. And here's the critical point. The projects funded by borrowing rarely generate enough economic return to pay for themselves. A new highway might boost economic activity by 2% annually, but if it costs $10 billion to build and the interest rate is 5%, it needs to generate $500 million per year just to pay the interest. Most infrastructure projects don't clear that bar. Social programs almost never do. Military spending definitely doesn't. So the country keeps borrowing because the alternative is admitting the previous borrowing wasn't productive enough to sustain itself. This is how stage one transitions to stage two. The borrowing continues, but the economic returns diminish. Each new dollar of debt generates less economic growth than the previous dollar. Eventually, you reach a tipping point where new borrowing generates no additional growth at all. Some economists call this the debt saturation point. When a country reaches debt saturation, additional borrowing actually reduces economic growth because resources get diverted from productive investment to debt service. Japan reached this point in the 1990s. After decades of rapid growth fueled by borrowing and investment, the economy stagnated. Government debt kept rising, but growth stalled. Italy reached it in the 2000s. Their economy hasn't grown meaningfully in over 2 decades despite continuous borrowing. The United States might be approaching this point now. Each new dollar of federal debt generates less economic growth than it did in previous decades. Stage 2 is debt service consuming growth, the warning phase. This is when interest payments on existing debt start consuming a larger and larger share of government revenue and economic output. The country is still growing, but more slowly. The debt is growing faster than the economy. The gap between debt growth and economic growth widens every year. Politicians try to solve this by borrowing more, not less. They argue that more infrastructure spending will boost growth enough to make the debt sustainable. They're usually wrong. At this stage, the country is borrowing primarily to maintain current living standards, not to invest in future productivity. The borrowed money goes to pay government salaries, fund social programs, and service existing debt. Very little goes to productive investment that might generate future growth. This creates a psychological trap. Citizens have become accustomed to a certain level of government services and benefits. Cutting spending means cutting those services. Raising taxes means reducing disposable income. Both options are politically painful. Borrowing more allows politicians to maintain services and benefits without immediate pain. But it makes the long-term problem worse. The mathematics of stage 2 are relentless. If debt grows at 7% annually and the economy grows at 3% annually, debt as a percentage of GDP rises by approximately 4% per year. A country that starts stage 2 with debt at 60% of GDP will reach 100% of GDP in about 10 years. At 100% of GDP, interest payments start consuming enormous amounts of government revenue. At 120% of GDP, which takes another 5 years, the situation becomes critical. Greece reached 120% of GDP in 2009, just before their crisis exploded. Italy has been above 120% for years and struggles with stagnant growth. The United States crossed 100% in 2020 and shows no signs of slowing down. These aren't arbitrary numbers. They represent mathematical thresholds where debt dynamics become self-reinforcing and increasingly difficult to control. But stage 2 has another dangerous characteristic. It creates the illusion that the problem can be managed indefinitely. Politicians point to countries like Japan, which has maintained debt above 200% of GDP for decades without defaulting. They argue that as long as creditors keep lending, the debt isn't a real problem. This reasoning is seductive but fundamentally flawed. Japan can sustain extreme debt levels because Japanese citizens hold most of the debt. They save enormous amounts and buy government bonds with their savings. When a country owes money to its own citizens, default becomes a political choice rather than a mathematical inevitability. But most countries don't have Japan's unique circumstances. Most sovereign debt is held by foreign creditors who can withdraw their capital at any time. When foreign creditors lose confidence, the situation changes rapidly. And that's where stage 3 begins. The transition from stage 2 to stage 3 often happens suddenly, triggered by external events that reveal the underlying weakness of the debt structure. Stage 3 is refinancing becomes essential, the dependency phase. By this point, the country cannot function without continuous access to credit markets. They're not just borrowing for new projects or economic stimulus. They're borrowing to pay interest on existing debt and to refinance bonds that are coming due. This is when the debt trap becomes visible to everyone, including the creditors. Here's why stage 3 is so dangerous. Most government bonds have maturities between 2 and 10 years. That means every few years the government has to find new creditors willing to lend them money to pay back the old creditors. It's like having a credit card with a balance that you can only pay by getting a new credit card. As long as new creditors keep appearing, the system works. But if creditors start demanding higher interest rates or refusing to lend altogether, the government faces immediate crisis. Portugal entered stage 3 in 2010. Their debt wasn't the highest in Europe, but creditors started questioning whether Portugal could repay. Interest rates on Portuguese government bonds spiked from 3% to over 7% in a matter of months. At 7% interest rates, Portugal's debt service costs became unsustainable. They needed emergency loans from the European Union and International Monetary Fund just to avoid default. Ireland had a similar experience the same year. Their debt had exploded after they guaranteed the debts of their failing banks. Suddenly, the Irish government owed money they couldn't possibly repay through tax revenue alone. When creditors realized this, Irish bond yields spiked to 9%. The government couldn't refinance their existing debt at those rates. Emergency bailouts became the only option to avoid immediate default. Stage 3 creates a vicious cycle. Higher interest rates make the debt more expensive to service, which makes creditors more nervous about the government's ability to repay, which drives interest rates even higher. Countries in stage 3 often see their borrowing costs double or triple in a matter of months. This acceleration is what makes sovereign debt crises so sudden and severe. The psychological dynamics of stage 3 are crucial to understand. Creditors start paying attention to debt sustainability metrics they previously ignored. Debt to GDP ratios that seemed manageable at 3% interest rates become terrifying at 8% interest rates. Credit rating agencies downgrade the country's debt, making it even more expensive to borrow. Financial media begins covering the debt situation, which spooks more creditors. The attention becomes self-fulfilling prophecy. Politicians in Stage 3 face impossible choices. They can implement austerity measures, cutting spending and raising taxes to convince creditors they're serious about repayment. But austerity typically reduces economic growth, which makes the debt-to-GDP ratio worse, not better. Alternatively, they can continue spending and hope economic growth eventually outpaces debt growth. But this requires creditors to keep lending at reasonable rates, which becomes less likely as the debt grows. The International Monetary Fund often intervenes during Stage 3, offering loans in exchange for austerity commitments. These IMF programs can provide temporary relief, but they come with conditions that are politically and economically painful. Countries must cut government spending, privatize state assets, reduce social programs, and implement structural reforms that often increase unemployment in the short term. Greece accepted 3 separate IMF programs between 2010 and 2018. Each program provided enough money to avoid default for a few more years, but required increasingly severe austerity measures. Greek GDP contracted by 25% during this period. Unemployment reached 28%. The social cost was enormous, but the alternative was complete financial collapse. Stage 3 can last for years if creditors remain willing to lend and if the government implements credible reforms. But it's inherently unstable. The country remains dependent on the continued confidence of creditors who are becoming increasingly nervous. Any external shock, any political crisis, any economic downturn can push the situation from Stage 3 to Stage 4, and Stage 4 is where mathematical inevitability takes over. The transition from Stage 3 to Stage 4 often happens overnight. A credit rating downgrade, a political scandal, a change in global interest rates, a crisis in a similar country. Any of these events can trigger a sudden loss of confidence that makes borrowing impossible at any reasonable interest rate. When creditors decide a country cannot repay its debts, they stop lending. And when they stop lending, default becomes unavoidable within months or even weeks. Stage 4 is confidence collapses, the point of no return. This is when creditors conclude that the mathematics don't work. Even if the government cuts spending dramatically, even if they raise taxes significantly, even if the economy grows faster than expected, the debt burden is too large to be sustainable. Once creditors reach this conclusion, they demand interest rates so high that borrowing becomes impossible. Argentina experienced Stage 4 in 2001. After years of mounting debt and economic stagnation, creditors lost confidence in Argentina's ability to maintain its currency pegged to the US dollar. Interest rates on Argentine bonds spiked above 15%. At those rates, Argentina would have needed to devote more than 100% of government revenue just to pay interest on the debt. Default became inevitable within months. The psychology of Stage 4 is fascinating and terrifying. Creditors who were happy to lend money just months earlier suddenly refuse to lend at any price. This isn't irrational behavior. It's mathematical reality finally asserting itself. When a country needs to borrow 20% of GDP annually just to service existing debt and fund basic operations, creditors realize they're not really lending to a government anymore. They're funding a Ponzi scheme. What makes Stage 4 so brutal is the speed. Countries can go from manageable borrowing costs to complete credit market lockout in a matter of weeks. Lebanon experienced this in 2020. Their borrowing costs were already elevated but manageable. Then the banking system collapsed, the currency began free-falling, and suddenly no one would lend to the Lebanese government at any interest rate. They went from refinancing debt normally to complete default in less than 6 months. The signs of stage 4 are unmistakable. Bond yields spike above 10%. Credit default swaps, which are essentially insurance against default, start pricing in a high probability of non-payment. Foreign investors begin dumping the country's bonds and currency. Capital flight accelerates as wealthy citizens move money offshore. The central bank starts burning through foreign exchange reserves trying to defend the currency. Politicians in stage 4 often resort to increasingly desperate measures. They might implement currency controls to prevent capital flight. They might raid pension funds or sovereign wealth funds to make debt payments. They might print money to fund government operations, which triggers inflation and further erodes confidence. These measures sometimes buy a few more months, but they rarely prevent the inevitable. The international community's response during stage 4 is typically too little, too late. The International Monetary Fund might offer emergency loans, but the conditions are often so severe that accepting them is politically impossible. Other countries might provide bilateral assistance, but usually only enough to prevent immediate collapse, not enough to restore market confidence. Russia faced stage 4 in 1998. Despite having significant oil reserves and a relatively small debt burden, creditors lost confidence in the government's ability to maintain the ruble's exchange rate while servicing foreign currency debt. When the government tried to defend the currency by raising interest rates to 150%, it became clear the situation was unsustainable. Default followed within weeks. The corporate sector often collapses before the sovereign during stage 4. Companies that had borrowed in foreign currency find themselves unable to repay when the domestic currency weakens. Banks that had bought government bonds as safe assets suddenly face massive losses. The financial system begins to freeze up as institutions stop lending to each other. This creates a feedback loop that accelerates the crisis. Corporate defaults reduce tax revenue, making the government's fiscal position worse. Bank failures require government bailouts, adding to the debt burden. Economic contraction reduces GDP, making the debt-to-GDP ratio even more alarming. Each problem makes the others worse. Stage 4 also reveals the political impossibility of the situation. The austerity measures required to restore creditor confidence are so severe that they would likely trigger social unrest or government collapse. Cutting government spending by 30% means firing teachers, nurses, and police officers. Raising taxes by 50% means destroying what's left of economic activity. No democratic government can implement such measures and survive politically. This is why stage 4 almost always ends in default rather than successful adjustment. The mathematics might theoretically allow for a solution through extreme austerity, but the political reality makes such solutions impossible to implement. Creditors understand this, which is why they stop lending once stage 4 begins. The international precedent for stage 4 is well established. Creditors know that once a country reaches this point, default is the most likely outcome regardless of the government's intentions or promises. This knowledge becomes self-fulfilling as creditors refuse to roll over existing debt, forcing the government into an immediate liquidity crisis. Some countries try to avoid stage 4 through preemptive default or debt restructuring during stage 3. This can sometimes work if done early enough and if creditors believe the country can return to sustainability after a manageable haircut. Uruguay successfully restructured its debt in 2003, avoiding the complete collapse that Argentina experienced. But timing is everything. Wait too long, and creditors lose all confidence in any restructuring proposal. The duration of stage 4 varies, but it's always measured in months, not years. Once the credit markets close, governments typically have between 3 and 12 months before they run out of cash to pay essential bills. The exact timeline depends on foreign exchange reserves, the government's ability to print money without triggering hyperinflation, and how much of the debt comes due in the immediate term. During this period, governments often try increasingly creative solutions. They might propose debt swaps, offering new bonds with different terms in exchange for existing bonds. They might seek emergency financing from non-traditional sources like China or sovereign wealth funds. They might threaten to leave international organizations or default on specific creditor classes to gain negotiating leverage. These tactics rarely work because the fundamental mathematics haven't changed. The debt burden that was unsustainable before these measures remains unsustainable after them. Creditors see through the financial engineering and understand that cosmetic changes don't address the underlying problem. The human cost of Stage 4 is enormous but often overlooked in discussions of sovereign debt. Government workers stop getting paid. Social programs get suspended. Infrastructure maintenance halts. Medical supplies become scarce. The country begins to resemble a failed state even though it might have significant natural resources or human capital. This social deterioration accelerates the economic collapse. Skilled workers emigrate. Foreign investment disappears completely. Tourism evaporates. Even domestic companies struggle to operate without reliable government services or banking systems. The economy contracts much faster than the models predict because the models don't account for the complete breakdown of institutional functionality. Stage 4 creates lasting damage that persists long after any eventual debt restructuring. The country's credit rating remains impaired for years or decades. Foreign investors demand much higher risk premiums for any future lending. The government loses access to international capital markets for extended periods. This makes recovery much more difficult and expensive. The political consequences are equally severe. Governments that preside over Stage 4 crises typically get voted out of office or overthrown entirely. The social contract between citizens and the state breaks down when the state can no longer provide basic services or honor its commitments. Political extremism often flourishes in this environment as people lose faith in conventional solutions. And then comes Stage 5, where the mathematics finally win and the debt gets resolved through methods that would have been unthinkable just years earlier. The only question becomes not whether default will happen, but what form it will take and who will bear the losses. Stage 5 is default or restructuring, the mathematical resolution. When Stage 4 reaches its inevitable conclusion, the pretense ends. The country formally acknowledges what creditors already knew. The debt cannot and will not be repaid as originally promised. This isn't a policy choice anymore. It's mathematical reality finally asserting itself through legal mechanisms. But sovereign default isn't like personal bankruptcy. There's no international court that can seize a country's assets or force liquidation. Instead, default takes one of three forms. Outright repudiation, where the government simply stops paying. Negotiated restructuring, where creditors accept reduced payments. Or stealth default through hyperinflation that pays back debt in worthless currency. Each method transfers losses from the government to different groups of creditors and citizens. Argentina chose outright repudiation in 2001. President Fernando de la Rúa announced that Argentina would suspend payments on $132 billion of government debt. The largest sovereign default in history at that time. They didn't negotiate, they didn't offer alternative terms. They simply stopped paying and dared creditors to do something about it. The peso immediately devalued from 1-to-1 with the dollar to 4-to-1. Overnight, anyone holding pesos lost 75% of their wealth. The social explosion was immediate. Riots in Buenos Aires. Banks closed for months. The government froze bank accounts to prevent capital flight. Middle-class families who had saved in pesos for decades discovered their life savings were worthless. 5 presidents resigned in 2 weeks as the political system collapsed along with the currency. But within 3 years, Argentina was growing again. Default had wiped the slate clean. Greece chose negotiated restructuring in 2012. After 2 years of pretending their debt was sustainable, European leaders finally acknowledged reality. Greek debt was reduced from €206 billion to €106 billion through something called private sector involvement. Private creditors, mostly banks and hedge funds, were forced to accept 53% losses on their Greek bonds. But the restructuring came with conditions that made Argentina's chaos look gentle. The European Union and International Monetary Fund imposed supervision over Greek government spending that effectively eliminated Greek sovereignty. EU officials had to approve the national budget. Privatization programs were mandated. Tax collection was outsourced to foreign companies. Government employment was slashed by 30%. The restructuring avoided complete collapse but turned Greece into a protectorate. Germany chose hyperinflation in 1923. Rather than formally default on war reparations and domestic debt, the Weimar government printed marks until the currency became worthless. Debt that had been denominated in marks was effectively eliminated because marks became worthless. A mortgage that required 100,000 marks in 1920 could be paid off with pocket change by 1924. Debtors won. Creditors and savers were wiped out completely, but hyperinflation destroyed the social fabric along with the currency. The German middle class, which had dutifully bought government bonds and saved marks, lost everything. Workers demanded daily pay because money lost value by the hour. Farmers refused to sell food for worthless paper. Children played with stacks of billion-mark notes because they were worth less than toys. The economic chaos created political conditions that would later enable extremism. Each default method creates different winners and losers. Outright repudiation benefits the government and domestic debtors at the expense of foreign creditors. Negotiated restructuring typically protects some creditor interests while imposing harsh conditions on citizens. Hyperinflation eliminates debt holders but destroys everyone who holds the currency. The choice of method depends on political calculations about which groups have more power to resist losses. Modern sovereign defaults tend toward negotiated restructuring because complete repudiation brings severe international consequences. Countries that simply refuse to pay find themselves excluded from global financial markets, international trade systems, and sometimes diplomatic relations. Argentina discovered this after 2001. They couldn't issue new international bonds for over a decade. Import financing disappeared. Foreign investment stopped completely. The negotiated restructuring process reveals the true power dynamics in international finance. Creditors with political influence in major powers get better treatment. European banks holding Greek debt received bailout money from their own governments, making Greek taxpayers ultimately responsible for bailing out German and French banks. Hedge funds that bought distressed debt at deep discounts often recover more than original creditors who held bonds to maturity. International law provides little protection for either creditors or debtors in sovereign defaults. Unlike corporate bankruptcy, there's no established procedure, no bankruptcy court, no automatic stay on collections. Everything gets negotiated based on leverage and political pressure. Creditors can hire expensive law firms and lobby their home governments for pressure. Debtor countries can threaten broader political consequences if pushed too hard. The human cost of Stage 5 varies dramatically depending on implementation. Argentina's chaotic default created immediate suffering but quick recovery. Greeks managed restructuring avoided immediate collapse but imposed grinding austerity for a decade. Germany's hyperinflation destroyed savings but eliminated debt. The choice between quick catastrophic pain versus prolonged manageable suffering becomes a political calculation. Recovery from Stage 5 depends largely on what caused the original debt crisis. Countries that borrowed to fund consumption rather than productive investment struggle to grow after default because they haven't built the economic capacity to generate higher output. Countries that borrowed for infrastructure or education can sometimes recover quickly because the underlying investments eventually pay off even if the original debt was unsustainable. 5 stages. Every single time. Argentina learned this 9 times. Greece discovered it despite being in the European Union. Lebanon is living it right now. The mathematics don't care about politics, promises, or pride. When debt grows faster than the economy can support, when refinancing becomes impossible, when confidence evaporates, default becomes inevitable. The pattern has played out for centuries across every continent, and it's playing out again today. Look around. Count the countries in Stage 2, Stage 3, Stage 4. The sequence doesn't break because the math doesn't lie. And somewhere right now, another government is entering Stage 1, convinced they're different, convinced they can manage what no one else could manage. The cycle continues because the lesson is never learned until it's too late.